The earnings are actually relatively solid. I tend to agree with Jeff. If you take out that big provision in the US, which as we say is a legacy issue, I think the issue for the market, isn't it, is the market saying this is peak, and that's why all the banks are reacting so badly, so weakly to what look like fairly benign set of earnings. Why is it peak? Why is it likely to be peak? Well, it's clear that we're now starting to get competition for deposits, aren't we? So that net interest income is like as good as it gets.
Right.
If inflation doesn't drop, we're then going to have a higher rate cycle, so that would be good for the top line, but of course we'd then have potentially higher provisioning.
Yeah.
So they're a bit caught between two stools at the moment, the banks, and I think that's what the market doesn't like.
Yeah, so interesting. So it's almost as though the good run for banks is coming to an end, either because we're at the peak of the cycle, or if central banks have to continue, it means that we're likely to see more credit provisions come up from the banking system as well. So, but then, even though banks did have a good run, the valuations are still looking pretty cheap. Why have that not caught up with some of the dynamics at play?
Well, there's the great saying, which is often very valid, which is you don't buy cyclical sectors on low earnings multiples, which sort of feels counterintuitive, doesn't it? But in a way it makes total sense, because the market is very good at sniffing out when something's at peak. And of course, what's going to drive banks from here has to be more earnings momentum. You're unlikely to get a re-rating if the earnings are declining, and that's what basically the market is saying. Now, how could you square the circle? What would make you bullish on banks? I think if you find a very solid bank that can deliver strong dividends, then obviously you can make your money through the income side. But in terms of expecting a huge re-rating from banks from at this peak earnings level, I think that's probably over-optimistic, to be fair.
Well, perhaps we already know the answer to this question based on what you've just explained. But there's growing speculation now over the last 24 hours or so that the ECB could even opt for a 50 basis point hike at its next meeting. Do you see that as a positive catalyst for the banks on the basis that it could be a boost to net interest income, or a negative given the implications for a recession down the line?
Yeah. I mean, the rule of thumb for me is that the first sort of 150 basis points of rate rises from a low level, that's a positive for the banks, because it's telling you we're going into a recovery environment from a business cycle perspective, and obviously then you get that catalyst on the top line. The next sort of 150 is roughly neutral, and we're in that latter stage where inflation is going to fall. I mean, I heard, as Jeff says, the ever-smooth Sergio Amotti on saying that he was worried about inflation continuing to rise. It's obviously a risk, but if you look at commodity prices and all the lead indicators, it's pretty clear inflation is going to come down in the short term, and probably quite quickly. So we're definitely in that last phase of rate rises, and that's where it tends to be less positive for the banks. I think the risk you've actually got for the banks is that we then end up with a situation where you have competition for funding, but you also have the market starts to think about rate cuts maybe in 6 months' time. And, is that going to really be a positive for the banks? Obviously, lower rates tend to hinder earnings, not help. So they're a bit caught, really, to be honest, at the moment, those banking
and potentially
share prices.
higher provisions, higher credit losses in between those two outcomes.
Right, exactly. And then, of course, with UBS, you've got the specific idiosyncratic issue of what do you do with the Credit Suisse merger, and how's that going to play out? And you're in a vacuum at the moment on that.
Let me broaden the conversation out, because you've got a pretty striking line about broader markets here, that you think we're on the cusp of unleashing the dragon. We could be approaching a golden age of growth. That certainly draws contrast to what a lot of the analysts say who joined Jumana and me on set. They're thinking about how much we are going to see the economy contract, but you seem in a very different camp.
I am more positive, actually. And why is that? A lot of the way we look at the economy is obviously calibrated to the last 15 years, which has been this lower for longer disinflationary, deflationary cycle. And what you've seen as a consequence of that is a lack of investment in so many different areas, isn't it? And that's what's caused the big spike in commodity prices, in energy prices more recently, and effectively the cost of living crisis. But we haven't yet seen the positives that come out of a higher inflationary environment. And you're starting to see, and obviously I look at a lot of companies are starting to invest again. Governments are starting to invest again. So you start to see this better nominal growth rate. And of course, although real growth might not be great, companies operate in a nominal world. So top lines are starting to grow very quickly again. And I think that you could end up in this sort of virtuous circle. I mean, I remember in 2011, 2012 in the US, we used to talk about would they achieve escape velocity?
Yeah.
You know, and I think that's where we're starting to get to with markets. Once we get through this peak inflationary period, the cost of living crisis, I think coming out the other side, you could end up with a very positive environment. So I'm a lot more bullish, I think, than some.
Based on what you're saying, that you're screening all of these companies based on the strength of the balance sheets and how much cash flow they have, because ultimately that's going to determine how much money they can put towards investment. So which are the companies or sectors that stand out in that space?
Yeah, so industrials, clearly. You know, anybody supplying an industry that's underinvested. So, for example, steel. The steel was in a bear market for the last 15 years. There hasn't been a huge amount of growth. So from a capital cycle perspective, those companies are now starting to invest. There's obviously the decarbonisation imperative, let's say, for a lot of these industries. If you're supplying those industries, capital goods suppliers, mining equipment suppliers, you know, you're in a really good place and you're starting to see order books, you know, really take off in those areas.